Welcome to Looking at the Markets with David Modell. Today I'm going to tell you about the 3-day rule. This is a super important rule. Now, I like to buy great companies when they go down, but you don't want to catch a falling knife because you'll cut yourself, right? Meaning that you don't want to buy a stock while it's falling really fast. You want to wait until it's done falling, or at least done falling quickly. And so the way to help you with that is to follow the 3-day rule. And that rule is after a big drop in a stock, wait at least 3 trading days. Not calendar days, okay, 3 trading days. For example, if it's Friday, all right, Saturday and Sunday don't count. And so Friday, Monday, Tuesday, Wednesday. So if it's Friday, wait until at least Wednesday, for example. 3 trading days. Wait 3 trading days minimum before you buy it. And you might even want to wait longer if it's still falling fast. Okay, but I'm talking about minimum wait 3 trading days. Here's an example. This is the daily candlestick chart. Each candlestick represents 1 day of price action for AMD, American Micro Devices. Now, I believe this is a great company, and so I want to buy it when the price is low, when it goes down. But I don't want to catch a falling knife. So here you can see there was an earnings miss, and the price of the stock went down a lot in 1 day, okay? And you might have been tempted to buy it here, but no, don't do it. Follow the 3-day rule. Wait at least 3 trading days before you buy it. So let's say this happened, I don't know, let's just say it happened on a Thursday. Wait at least until, remember it's 3 trading days, so Friday, Monday, Tuesday. Wait until at least Tuesday before you even consider buying it. And even then, only if it's not falling fast anymore. You know, you want it to be going sideways, or better yet, going up a little bit at least. All right, but you got to wait at least 3 trading days. So there was an earnings miss, and the price went down a lot. If you had bought here, if you had not followed the 3-day rule, then you would have maybe bought here, and then you would have been in trouble because it went down, down, down over the next few days. You might have bought it here. Okay, you might have waited just 1 or 2 days and bought it here because you're thinking, well, there's a support line here. Look, it bounced off of this line several times before, but again, you should have waited at least 3 trading days. All right, so that's AMD. Let's look at some other examples. By the way, when a stock misses earnings and goes down a lot, and then continues to go down the next few days after that, that's called post-earnings drift. Meaning that after earnings, the stock price will probably, not always, but oftentimes will continue going in the same direction as it did on the earnings, all right? So if it goes down a lot, then it'll probably, not always, but probably continue in that same direction, at least for a few days. That's called post-earnings drift, and it works not only to the, it's true usually not only to the downside, but also to the upside. Let's look at an example of Netflix, all right? We have an earnings beat here. It beat earnings, Netflix. So it went up a lot that day, and look, there's post-earnings drift to the upside. Over the next few days, it kept going up in the same direction. Not as fast, but it started to slow down going up, but it did keep going up, so you don't want to fight that either. All right, so here's Twitter, and here's another example of post-earnings drift. All right, it had an earnings beat, okay, way up there, and then the next day, kept going in the same direction very strongly. Look at that big candle there. All right, so post-earnings drift works in both directions. All right, but again, I like to buy really great companies when they go down. So United Continental Holdings, all right, that's an airline stock, and I like the company, so I like to buy it when it's cheap. Here's an earnings miss. See that big red candle there? Okay, it went down, down, down. All right. And then if you had jumped the gun and not followed the 3-day rule and waited at least 3 trading days before you even consider buying it, it just kept going down over the next few days, and actually over the next several weeks it kept going down. All right. So there's a good example. Here's another good example. Same stock, another earnings miss here. Missed earnings, went down, and then if you had not waited at least 3 trading days, look what happened the next day. Big red candle down. Okay, you would have gotten hurt there. So make sure that you wait at least 3 trading days before you consider jumping into a stock that has gone down a lot. Not just because of earnings. These were all earnings misses, these examples and earnings beats, but if a stock moves in a particular direction really fast for any reason, it could be, maybe it goes down not just because of earnings, but because of, a scandal happened or whatever, okay, or just bad news. Wait at least 3 trading days. Wait for investors to calm down. Wait for analysts to stop downgrading the stock, all right? And just wait for the bleeding to stop in the stock before you even consider jumping in with a long position. So that's the 3-day rule. It's really important, and I just wanted you to know about that so you don't get hurt. So if you like this video, if you found it useful, please give it a thumbs up on YouTube and leave a comment in the comments section below this video. And if you have not done this already, please subscribe to my YouTube channel so you can receive the latest updates on my educational videos. And if you'd like some assistance with putting together a trading plan or with candlestick charts or trading or investing, my name is David Modell, and you can email me anytime at davidmodell@gmail.com. Thank you so much for watching and listening, and I'll talk to you again soon.